A financial time bomb is ticking beneath the foundations of the American economy. As we stand on the cusp of 2026, the strategy of extend and pretend that has propped up the market for years is finally reaching a violent and abrupt end. We're talking about over $2 trillion in commercial real estate loans hitting what experts call the maturity wall, a financial cliff that most banks, especially smaller ones, are simply not prepared to face. The critical question isn't whether a crash is coming. The reality is, it's already here. Today, we're pulling back the curtain to expose the banks that are standing on the very edge of the abyss. For decades, towering office buildings were seen as the gold standard of safe investments, the bedrock of many portfolios. But the world shifted dramatically after 2020. The rise of remote and hybrid work has left city centers looking like ghost towns. Vacancy rates have soared to unprecedented levels, and as a result, property values have plummeted. Just think about this. In 2026 alone, nearly $1 trillion in commercial debt is due for refinancing. But here's the catch. It has to be refinanced at today's much higher interest rates. With building values down by as much as 50% in major cities like San Francisco and Chicago, many property owners are making a stark choice. They're simply walking away, handing the keys back to the banks. This is the maturity wall, and it's poised to send a devastating shockwave through the credit markets. You might think this is a problem for the big players, the too big to fail banks. While giants like JP Chase and Bank of America have diversified their portfolios since 2008, America's regional and community banks are in a much more precarious position. They are dangerously overleveraged. The data is alarming. Analysis reveals that hundreds of these smaller banks are holding commercial real estate loans that exceed 300% of their total equity. That is a staggering level of exposure. Regulators consider any bank over this threshold to be at significant risk. Let's break down what that means. If just 10% of these loans default, a very real possibility given the current market, these financial institutions could face immediate insolvency. They would be wiped out. We are not just talking about a minor tremor. We are looking at a potential repeat of the 2283 banking jitters that saw several regional banks collapse. But this time, on a much larger, more systemic scale. It's a domino effect waiting to happen. And this isn't just a problem for billionaires and corporate landlords. The ripple effects will touch every single one of us. When these regional and community banks freeze up or fail, the lifeblood of the American economy stops flowing. Small business loans that create jobs, mortgages that allow families to buy homes, and consumer credit that fuels spending, all of it could vanish overnight as banks scramble to cover their catastrophic losses. The commercial real estate crisis of 2026 isn't just another headline. It is the first domino in a sequence that could trigger the most significant and painful recession of our lifetime. The numbers don't lie, the trends are clear, and the clock is running out. This isn't fear-mongering, it's about understanding the financial earthquake rumbling right beneath our feet. Are you prepared for the great banking shift of 2026? What steps are you taking to protect your finances? Let us know your thoughts in the comments below. Thanks for watching, and if you found this breakdown valuable, make sure to subscribe for more insights.